Let's talk about where we are in the overall economy. The Fed came out and said that they were not going to raise rates, but they're not going to lower rates either. They're going to keep rates higher for longer. The economy is still relatively strong. The jobs market is relatively strong. 12 of the 19 Fed board members said that they could foresee rate hikes between now and the end of the year at the next FOMC meeting. The markets are pricing in currently no rate hikes towards the end of the year, or a very small chance, and then no rate cuts until September of 2024. So right now, what's going on in the economy and with the Fed is, with inflation still higher than what they want and pressuring a lot of people out there, the Fed is really, they're kind of really handcuffed. There's not a whole lot they can do. They can't really cut interest rates at this point because that would create another spike in inflation. So right now, they kind of have to keep policy higher for longer, continue to tighten monetary policy, financial conditions, so that inflation can continue to subside, in essence, slowing the economy, because the economy works in cycles, right? It's business cycles, peaks and valleys. When the economy is running hot, the Fed wants to raise rates to slow the economy down. When the economy is slow, the Fed needs to stimulate by cutting rates. And where we've been since the great financial crisis of 2009 is in effectively a zero interest rate environment for a very, very long time, and lots of liquidity created in the economy to support financial assets, including residential and commercial real estate. So as we dig into this topic and start looking at the state of the housing market, the state of commercial real estate, one of the big questions that a lot of people have right now is, why hasn't real estate crashed? A lot of people are wondering, with rates going up as high as they have, why hasn't real estate crashed at this point, especially in the commercial market, with all of the vacancy in office since the pandemic and the work from home environment. We haven't seen a lot of workers return to office at scale to fill those office buildings. And you see in the news every day about big office buildings that are empty, that are getting sold for a third of what the investors paid for them. You're hearing about other stress in the multifamily market with people that had interest-only loans, variable rate loans, where the interest rates are rising on those because the Fed funds rate affects commercial interest rates, banking rates, more than it does the housing market. The housing market is different. So one of the reasons is real estate is a very slow-moving segment of the market. It's a slow-moving asset class. And since 2009, a lot of things have been put into place for investors and homeowners to work out situations when they come under pressure. So whenever a commercial property is under stress, it takes a little bit of time to trigger default and then to trigger any kind of action on the part of the lenders. And generally, those investors put a good down payment on those properties, which is called equity. So the banks aren't really under a tremendous amount of pressure if the properties drop in value a little bit. The commercial real estate market is a pretty big segment of the economy. It's a $20 trillion plus or minus market, $20 to $30 trillion, depending on where values are at any given time in the United States. And currently, there's about $4 trillion worth of commercial debt outstanding. And out of that, about $1.2 trillion has to be paid off or refinanced in the next year to 18 months. So when you have a situation like that, the banks and the investors and the lenders, everything moves really, really slow. So it takes a lot of time for something like that to create any kind of a problem where you get any kind of a crash. Now, what has crashed is transactions. Commercial real estate transactions are down 70 to 80% all across the country. So that is affecting things. Sellers are still wanting prices when interest rates were very, very low, like we saw over the last couple of years, but the buyers can't make the numbers work at the current interest rates. So it's putting a lot of pressure on the market and creating a significant drop in commercial real estate transactions. Now, as far as the debt that has to be worked out and the workouts that I was talking about, when a commercial property goes into default, they have a lot of options. They can bring more equity to the table and refinance the debt. They can work out arrangements with the lenders. So in the multifamily market, where you have properties that are generating a lot of cash flow, those are much easier in some cases to work out than, let's say, an office building that's vacant or mostly vacant, where there's no income, and the investor or the sponsor that has that asset does not want to continue to put cash flow into that property and continue to lose money. So in some cases, they're just turning the keys back over to the lender and walking away. Those are what are called non-recourse loans. So the entities and individuals that get wiped out are the equity investors. So if it's a $100 million property, that investor probably put 30, $40 million down on it. The bank has a note for 60, $70 million. That could be sold off as commercial mortgage-backed securities. The debt could have come from a life insurance company, could come from maybe a commercial bank or a couple of commercial banks or investment banks. A lot of different ways that debt is funded on those properties. But at the end of the day, if the investor put the 30, $40 million down on a $100 million building and the bank takes it back, and then they in turn sell it off and take a little bit of a loss, the bank's going to take the least loss. The investors that put up the equity are going to take the biggest hit. And banks, for the most part, don't have a tremendous amount of exposure overall to the commercial real estate space. We're going to take a look at some numbers here in a little bit. Some of the largest banks out there, maybe 10 to 20% of their entire balance sheet is allocated into commercial real estate. And most banks are trying to get any kind of a bad debt exposure off of their books and sell off those loans. Like with SVB, the Silicon Valley Bank, when they failed back in March, they have unloaded their commercial real estate portfolio, which is currently out to bid and nobody's bidding on it. So they just keep dropping the prices. So one of the reasons the commercial real estate market hasn't crashed to date is because most of those properties do have cash flow, and they are very long duration, slow moving vehicles to work out. And there's a lot of options to work those properties out. As far as the housing market goes, there's a lot of people calling for a crash in residential housing, and especially in the Airbnb and rental properties and things like that. So to put a little perspective into the housing market, it's about a $47 trillion value of housing in the United States. So housing is worth about $47 trillion in the United States. Typically at any given time, you sell 4 to 5 million, right around 5 million houses a year get sold. Typically you have about 2.5 million homes on the market at any given time. So currently we're seeing transactions down to about 4 million in the last year, and we're seeing inventory levels at or below 1 million. They've been kind of bouncing back and forth between 1 million and 900,000 in terms of the amount of homes available for sale listed on the market. There's going to be some that are for sale by owner and transactions that happen under the table that don't get recorded by the traditional outlets that report and track those closings and transactions. So a lot of that stuff doesn't go through the MLS as far as listings, under contract, and sold properties. But one of the issues that we have right now is very little inventory across the board. So there's a lot of markets. So real estate is hyper local. Every market's different, and real estate's different in every market. So when you look at national averages, which is what I'm talking about, you have to break that down into local markets. And there are local markets that are struggling more than others, like Phoenix, Arizona, like Austin, Texas. Austin was one of the first markets to start seeing values decline because that market accelerated rapidly. What we've really seen is we've seen real estate valuations appreciate over the last couple of years, what you would normally see in 10 years. So we've seen 10 years of appreciation in housing, literally over a 2-year period since 2000, since the bottom of since the pandemic, 2020, because interest rates have been at record low levels, which drives the value of housing because people buy payments. So when it comes to the value of housing, it's all based on real estate valuations are basically based on a couple of things. Obviously, location can make a big difference. Supply and demand make a big difference. But at the end of the day, in a normal, healthy market, it's all about the availability of the debt and the cost of that debt. That's what really drives prices. And that's why we saw housing prices go so high over the last couple of years, because the debt was at record low levels. 40% of the homes in the United States are owned free and clear. Out of the remaining 60%, about 80% of those have mortgages below 6%. 30% are below 5%. About 20% of those are below 3%. So that's what really drove the values of residential housing, which also drove values of commercial real estate. Commercial real estate is valued based on cash flow by a mechanism called cap rate, which represents an unlevered return on cash. So in other words, if a property has a 3 cap and it's bringing in $100,000 a year in income, then that would be worth we'd have to do the math, $3 million or something like that. Or $30 million. Yeah, $30 million times 3% would be about $100,000 a year in positive cash flow. So those are what cap rates represent. It's like a unlevered return on your cash. It's like what you would get if you paid cash for the property for that return. So if you bought a property for $1 million and you expected to make a 3.5% return, then that would be basically $35,000 a year that you were looking to make on that property in terms of a cap rate. So I'm not using my calculator, so my numbers might be a little bit off. But at the end of the day, a $1 million property at 3.5% cap rate, that means your net operating income is $35,000 a year. So that's how that property, would get valued, would be on a formula based on that cap rate that somebody would pay. So that 35,000 divided by 3.5% would get you to $1 million, basically, is kind of how that works. So that's what drove the values of commercial real estate up so high, was because the interest rates were so low. So you were able to afford the properties based on the cash flow. And then there was a lot of competition. So demand ultimately is what drives values of anything. Same thing with the housing market. As inventories thinned out through the pandemic, because people didn't have to move, they were able to work from home. They locked in record low mortgage rates. People don't have to sell, they don't have to move. But the demand still remained high. There was a lot of competition for the houses. We saw lines down the street whenever houses came on the market, in some markets with 40, 50 to 100 buyers waiting to get in the house to see them, multiple offers going for well over asking price. We're still seeing multiple offers and properties sell for more than they're asking in some markets, but we're also seeing prices come down and price reductions and properties not selling in other markets. And even in some markets where properties are selling in days, that same market can have certain properties that aren't selling. So it's all about location, it's all about demand, and then it's all about the financing. Because at the end of the day, a lot of people are buying payments when they're buying houses, just like they are paying for cars. So one of the reasons that the housing market has not crashed is because interest rates were low. People were flush with cash. There were a lot of buyers, buying pressure from investors, from cash buyers, and then we had record low inventory. So just like in the jobs market, there's 3 or 4 job openings to every individual willing to take one. There are probably 10 buyers or more for every house that comes on the market in most markets, because that's kind of what we're seeing right now. Is you get 7 to 10 multiple offers generally on properties when they hit the market. So I'm going to jump in and show you some things on the screen here in terms of what I'm talking about when you start getting into interest rates and things like that. So this is a history of the 30-year mortgage going all the way back to 1971. And back in 1971, it was about 7.4%. And then it peaked into the 80s. You've heard a lot of people talk about 19 and 20% mortgages. Back in the 80s, and in 1981, it was 18.53%. This is the rate on a 30-year mortgage. In 1980, it was 18.53%. And you can see it's just been downhill pretty much ever since then. And one of the things that really drove the markets back in 04, 05, before the great financial crisis, were low interest rates in the 5s. So typically that 5 to 6%, those were record low mortgage rates historically, going all the way. Really, it started in 2000s. In the 2000s, rates kind of dropped after the dot-com bust into that 5 to 6% range, coming off that 7 or 8% range. I bought my first house in 1990, and I paid 9.75% interest right back in this area here. 1990, right there, rates were almost 10%. That was my first house. They dropped all the way down to 5%. I thought in 2004, 2005 that 5% was just unbelievable. Then we had interest-only loans that you could get down into the 3s, especially for investment properties. And then after the great financial crisis, rates kept dropping all the way down into the 3s. Down into 2013, 2014, that really stimulated the housing market, kind of stayed in that 3 to 4% range for a long time. And this is where you see housing really start to spike during that 2015 to 2018 timeframe. Then during the pandemic, rates dropped down into the 2s, 2.7. This is the 30-year fixed rate, 2.9. And now we're back up into 7%, almost, well, I guess 8%, depending on when you're watching this video and when I made this video. Rates are back up to 7 or 8% and just got there. So this is the same chart going back to 1971 on housing prices. And you can see this is median home price, the average sales price of houses in the United States. from 1971 in that $30,000-$40,000 range, all the way up to the $470,000 range at the peak here in 2023. And now it's starting to drop off again just a little bit. But, you can see that area post great financial crisis. And then, running up that 2015 to 2018, like we talked about, where housing kind of had some appreciation, stalled for a little bit when rates kind of went up. But as soon as rates dropped, people jumped back in. But rates have been spiking ever since. So that's one of the reasons that housing values have been on the rise so much, because the 30-year mortgage is based largely off the 10-year treasury, because that's the the risk premium that investors are looking for. I can invest in a 10-year treasury and get a risk-free rate of 4.5%, 5%, or I can invest in a mortgage and get a 7% return. So I got to have a premium, a spread above that. And the deeper we get into the higher rate environment and the more potential stress there is on real estate, the bigger spread the investors are going to want to see in that premium. So that's why we can spike up to 8, maybe even 9% before it's all said and done if the treasury rate hits that 5% level. So that's a pretty interesting thing to look at. And all of the talk in the market right now and the economy are how home prices are remaining strong despite higher rates. Because again, generally when rates go up, house prices will drop because you can't afford as much house based on the payment. And as rates go down, house prices rise. Well, right now we have skyrocketing rates and prices are not coming down. They're still remaining high. Pending home sales are dropping. So one thing that did crash in the housing market is transactions. And we're seeing it with home builders. We're seeing it with cancellations, where people are canceling pending contracts as interest rates are rising because they either can't afford them or they don't want to. So we're seeing a lot of cancellations. We're seeing transactions really, really drop. And with, the Fed's recent meeting talking about keeping rates much higher for much longer to get inflation under control, it's really, really started to affect things in the housing market. And you can see right now the median sale price is about 420,000. That's up 3% year over year. Number of homes sold, 475,576. That's down 14.5% year over year. That's that transaction crash we're talking about. And the number of newly listed homes, which is a big deal, is 536,703. It's down 13% year over year. So inventory keeps shrinking and contracting as we go along into the housing market. So how can you use this information to your advantage? So in the residential market, there are some investment properties, there are some Airbnb properties, and there are rental properties that individuals and institutional investors own. So one of the things that's happening in the housing market, so what you need for the housing market to correct is you need rising inventory. And in order for inventory to rise, you need people that are either willing or forced to sell. So you need forced selling, you need motivated sellers in order for the housing market to correct. And we're seeing price reductions in commercial and in housing, but again, those are price reductions based on historically overinflated values. So if they pull back 5 or 10%, well, they're still up 20 or 30% or more from pre-pandemic levels. So it's still in very overinflated housing market. If you adjust that for appreciation over the last couple of years, housing can pull back 20 to 30% in most markets, and so can commercial real estate, and still be relatively on track with normal appreciation rates in commercial real estate and housing. So it's going to be very interesting to see where that goes. But the thing to watch right now is insurance costs have doubled and tripled or more in some areas recently for commercial and for residential real estate, especially in the coastal markets and in the areas where we've seen wildfires and things like that. So that's putting a lot of pressure on investment property owners and owner occupants. We're seeing taxes go up. And if there's been any kind of tax forbearance, those taxes are now going to be coming due, but we're seeing them go up. Energy costs are rising. Maintenance and service costs to maintain a house, plumbing, electrical, HVAC, painting, whatever it is, yard work, gas, all of the things you need to maintain and improve your properties, those costs are going up. So that's putting pressure on especially investment property owners and some owner occupants. So as these costs continue to rise, if rents don't rise, accordingly in those rental markets, that can force some sellers to the market. But again, we have an imbalance of over 1 million homes in the housing market right now for normal inventory levels. So it's going to take a whole lot of sellers to hit the market to really bring that back to a normal level. Then there's a bunch of pent up demand. So how does this correct? If interest rates can remain high, over 7 to 8%, while some of this inventory starts coming to the market, we could see housing come back into balance. Same thing in the commercial market. As those properties come to the market that are under stress and they get sold off, or don't get sold off because interest rates are rising and deals don't work, that can continue to stack up some opportunities in the commercial world as well. So the key is you got to be patient, let this play out. Interest rates have really only gone up over the last year exponentially, and they need to stay there for a while. So if rates somehow come back down, that's going to bring a lot of people in both areas, commercial and residential, out of the woodwork and spur transactions and activity. So the key is watch for that distress, watch for forced selling, watch for areas where inventory is rising, whatever your market is. The real estate's hyper local, so you need to be paying close attention to your market inventory levels, interest rate levels. If you start to see a lot of properties coming on the market, if you see days on market increasing, things like that, then that could potentially create some opportunities for you, especially if you're seeing price reductions and things like that. So these are the things that I'm monitoring in the housing market.